All right, guys, welcome back to another training session that we're about to do on charitable planning strategies. I'm Heath Walters, and I hope you guys get to enjoy another session. It's more education. So let's talk about clients and families that just like to give money. You definitely see this more so in the retirement community, different market areas of the country. You'll see more charity. But when you identify a family that is charitable, understand that there are more strategies available to them than what most people really understand. So today what we're going to do is we're going to talk about 4 of them. There are 4 that you guys can recognize and identify for clients. There are more strategies that we will cover at some point in the time when we start getting into charitable trusts. That's not the point of today. Today is the basic, simple things for typical retirees. And there's a lot of value that you can bring from utilizing them. So anyway, what we see is that most families in retirement are not able to deduct their charitable contributions. And that's because the way that the standard deduction works, they just don't have enough mortgage interest, they don't pay enough in taxes, that they even making money in charitable contributions, they don't get above the standard deduction. So unfortunately, it's the equivalent of donating money but not really getting a deduction. So for families that give away $5,000, generally we see that they're just utilizing the standard deduction and not getting anything. We're going to talk about a couple different ways to get around that so you can actually allow the clients to see the deductions. So let's talk about first the Qualified Charitable Donation, or QCD. What this is you're allowed to donate your required minimum distributions directly to your favorite charity. For families that want to send it to their church or want to send it to Salvation Army, either which way it's okay. What happens in this scenario if a client does that is it prevents the RMDs from ever hitting their tax return. So we're able to basically deduct it before it ever got to the return. And I'm going to show you an example on the next page of how that works. All in all, families can donate up to $100,000 per year for an individual or $200,000 in a year for a married filing joint. Very few people donate that much, but there can definitely be some big numbers. So what does this look like? On this page here, what we're going to show you is what it looks like for a family that's giving away $15,000 a year and they owe $100,000 on their home. So this column down here is what's happening in their taxes, and we're going to go through that. The column on the right is what's happening inside of their itemized deductions. So I'm going to go ahead and start on the left-hand side to just give some breakout of what a typical family. Just assuming they've got IRA distributions, part of their RMDs, but just their lifestyle, $75,000 a year. They've got $40,000 of Social Security and another $40,000 pension. All in all, their adjusted gross income, $155,000. So this family, we're giving away $15,000 per year. Their itemized deductions are $25,142. So I'm going to break that out on the right here a little bit so that you can see what's happening here. If they were in a state, like I was using, I think, North Carolina, if they're in a state like Florida where you don't have state income taxes, they have to give away a lot more than $15,000 to be able to get an advantage. So in this scenario, the way that the itemized deductions work is you can deduct the greater of your itemized deductions that we calculate or the standard deduction, whichever is higher. So in this case, they've got $7,000 in state income taxes. They've got $3,000 in home mortgage, $100,000 at 3%, so nothing too big. Their charitable deductions are at $15,000. So all in all, their itemized deductions are at $25,142. Standard deduction is $25,000. So really, the family was automatically going to get $25,000 even if they didn't donate this $15,000. Really, for the $15,000, they actually got a $142 deduction, which is actually very sad. Not the way that it should be. So we're going to now break through what happens when we do qualified charitable deduction. Taxable income in this scenario is right at $130,000. That makes their federal taxes at $20,000, state income taxes at $7,000. So all in all, they're at $27,000. If we go in and give away the same $15,000 before tax using the qualified charitable deduction, what happens is the distributions on the IRAs drop. So instead of a $75,000 income hit on their tax return, it's now only $60,000. Now they made the same Social Security, the same pension, so their adjusted gross income is now $15,000 less, or $140,000. Itemized deductions is still $25,000 because we get the lesser of, we get the greater of the two. So even though if we were calculating this way, it's $7,000 in state taxes and only $3,000 in home mortgage, it's really only $10,000. Really, they go all the way up to $25,000. So this allows the client to, as you can see, the itemized deductions barely dropped, but our income dropped and our taxable income dropped significantly. All in all, before and after, that saves the client for over $4,000 in taxes. And the thing that's actually really difficult to understand and comprehend and even to explain to a client, and honestly it baffled me when I wrote this out, was I wouldn't have thought that was going to be a $4,000 tax savings, but it is. That's how much it actually impacts the family. So $4,000 on $15,000 is actually a really high percentage for a family only making $155,000. So make sure that you understand the impact of how good this really can be for families, and also for families that are making this kind of income, saving $4,000 in taxes. That's a really big deal. So it's a real big value add that you get to bring to the table. So we're going to talk about the next strategy. Next strategy is if you gift 2 years to your favorite charity. We just do it in 1 year. The way that I explain this to clients is, if generally you give the same $15,000 a year, instead of giving $15,000 all over the whole year, what we do is we give $15,000 in December and $15,000 in the $15,000 we were going to pay the next year, we give that in this December. So we just contribute all month, every single month, all year long, and then we add a $15,000 deduction. We just advance next year's onto the current year returns. So let's go look through an example and see what happens. And as you're going to start to see, actually it works exactly the same way as using the qualified charitable deduction. The numbers are so close. On the left-hand side, we made $75,000, $40,000, so all in all, everything's the same $155,000, itemized deductions are the same. And our taxable income is at $130,000, so our tax bill is the same $27,000. When we double up and do up to $30,000 right here, like we just did, then that moves our itemized deductions to $40,000. Now our taxable income dropped to the same as we did before, down to $114,000, saves us right at the same $4,000. So by doubling up, it allows us to get over that threshold of the standard deduction and be basically the same as the qualified charitable deduction. Either which way, what we're doing is we're finding missed dollars from the gap between the standard deduction and what you're not really getting to make an impact on taxable income. If you ever have a question on one of these, just give us the tax return for a client. We'll run the numbers for you and calculate it for you and show you what it is. That way you don't have to guess. We can do this stuff pretty quick. So number 3, talk about gifting appreciated stock directly to a charity. Why would we do that? Well, most families will take appreciated stock and they'll sell it and they'll pay taxes, but yet they're giving cash to a charity all year long. Charities don't pay taxes on anything. So if you give them stock and there's a gain in it, they don't have to pay taxes on it. But what we're advising for clients is basically, as you have capital gains, to donate the stock instead of making the monthly tithe over to the church, because this is a pre-tax method to do it. So let's go walk through what happens, just assuming we've got a $15,000 capital gain and we're given the same amount of money. Basically everything's the same here. What happens if we do this? Well, left-hand side, 75, 40, 40, all those numbers are the same. But now we've got a $15,000 capital gain. So our adjusted gross income moves up to $170,000, but yet our itemized deductions still are the same. We actually never picked up the extra benefit of the donation. As you can see, it's still stuck and we had to pay taxes. So all in all, our taxes bill goes up and we're up to over $30,000 combined. On the right-hand side, all our numbers stay the same, except we don't recognize that capital gain. That's what we've given. Our itemized deductions basically stay the same, and our taxable income drops again. So all in all, we're able to save the client almost $6,500 by donating appreciated stock at $15,000. Obviously, I didn't take in consideration the basis, how much it was. I'm just assuming a pure $15,000 gain. So there's a lot more calculations to be done. But as you can see, there's a lot of value in what's happening by just giving away the stock before you realize and pay the tax on it. So next is utilizing a donor advised fund. Donor advised fund is a way for a client to stack multiple years of donations, basically, and put it into a fund that they control, and then they can give it away to whoever they choose, whenever they choose in the future. Plus, as the advisor, you can still help the client. You can manage the assets that are within that fund. What we generally have clients do is gifting multiple years, just like we had done before. The difference being, if a family is going to take the deduction up front and they're going to double up, what they have to do is donate that $30,000, just assuming that it's their church. They would be donating $30,000 to that church real quick. And using a donor advised fund, what happens is they've contributed the $30,000. They've probably given $15,000 to their church in the first year, but then they can use the donor advised fund to give the church the same $15,000 the next year. It gives the client a little bit more control of their money. It doesn't change the impact that they're going to make. They can control the timing and then pick up more tax deductions today. So kind of nice. The tax savings in this are going to be, it's exactly the same as if you double up, because that's what you're doing. So the difference between the donor advised fund is that gives the client control on putting money in when they want to give it away, but still take the bigger deduction today. If they double it up, they have to actually give it away at that time. So it just depends on the client's uses of the money, what their desires are, their wishes are, and who they're giving to. I believe that's the end of the training session for today. So we'll join us on the next event.